Okay, welcome back. We want to continue with steps in decision making. There are a number of steps managers follow in making decisions. The first one is establish your objectives. You can write down your objectives. At the end of this process, this is what I envision to achieve. The second is specify the decision problem. So what problem are you solving as a manager? You specify the decision problem. Is it that sales have gone down, so we want to increase sales? So sales have gone down, that is my problem. Yeah. And the third is identify the alternatives. What are the different approaches you can apply to achieve the objectives you have set? So you identify the alternatives. It could be 2, it could be 3 or more. Now the fourth is you have to evaluate the alternatives, checking which one is better than the other. Then select the best alternative. When you check which one is better than the other, you choose the best out of them. Then implement the decision. Implementing the decision is using the selected alternative to make a decision. Then after the decision is made, you have to monitor the performance. The alternative you chose, you have applied it. Now what is the success of the alternative you chose? Are you attaining success, or there's been a failure? So constant monitoring of the performance. These are very good steps every manager must adapt in making decisions. Okay, so we want to move on to basic economic tools in managerial economics for decision making. There are some economic tools in managerial economics that are normally employed in making decisions. The first one is opportunity cost principle. I believe it rings a bell when you did economics in first year. So we'll be calling it OC, opportunity cost, OC. So OC of a decision is the sacrifice of alternatives required by that decision. So opportunity cost means you have sacrificed one alternative for another. So that in many decisions, that is what happens. An alternative is sacrificed for the other. Opportunity cost represents the benefits or revenue foregone by pursuing one course of action rather than the other. So if you decide to, for instance, the decision on what to produce. Maybe you want to produce chocolate or school bags. Maybe chocolate will sell very well. You don't know. School bags might also sell very well. Assuming I know the outcome of producing chocolate. When you produce chocolate, your profit will be 10,000 cedis, Ghana cedis. And if you produce school bags, your profit will be 5,000 Ghana cedis. So if you decide to choose chocolate, if you decide to choose chocolate, it means you are sacrificing 5,000 Ghana cedis you would have gotten if you had produced school bags. But it's a good decision to produce chocolate because chocolate will earn you 10,000 Ghana cedis. So that is opportunity cost, is the one foregone, the revenue you have given away in order to get something better. Opportunity costs are normally not recorded in our accounting records. So when an accountant gives you his statement, maybe a balance sheet or a trading profit and loss account or any document of an accountant, you will not see opportunity cost recorded in it. But economists consider it very important, all because it helps us to meet the firm's aims and objective of optimizing or maximizing profit. If you don't consider opportunity cost, you might not be able to maximize your profits very well. Decisions involving opportunity cost includes the following: either you make or buy. When you make, when you produce or you make, you are foregoing something. When you buy also, there is an alternative you are giving away. So as a manager, there are some things you are not supposed to make, you are supposed to buy, because making it will be very expensive. There are some things also you are not supposed to buy, you have the ability to make, so why don't you make? So any sacrifice alternative is the opportunity cost. I believe you do understand. A decision on make or buy. When you make, you sacrifice something. When you buy, you sacrifice something. Also, breakdown. You can be faced with this situation: breakdown or preventive maintenance of machines. So it's either you maintain your machines or you continue to use the machine and the machine will break down. When it breaks down, you have to repair it or buy a new one. So there is an opportunity cost there. If you choose to continue to use it for it to break down, there is a cost you incur. But if you want to save yourself that cost and continue to spend money to maintain the machine, also there is a cost you incur. So any of these decisions, there will be an opportunity cost. Remember, the opportunity cost is not the cost you are incurring, but the sacrifice you are making, the alternative, the other decision you could have made, you have not made, you didn't make, and because of that you are losing some amount of money. That is opportunity cost. And also you can be faced with a decision to replacement or new investment decision. Replacement or new investment decision. This can also have an opportunity cost. The last one is direct recruitment from outside or departmental promotion. If you recruit from outside, you have to pay them new salaries. If you promote someone, you have to pay him an increased salary. So all these are decisions that involve opportunity cost. We'll pause here and continue in the next slide.